You don't start things and not finish them. You don't quit. There's nothing that comes out of quitting besides knowing that you didn't finish. We finish everything. You start it, finish it. If you're going to do it to try and be the best. Not be better than other people, be the best for you.
The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, real estate investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all? Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time, because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.
Blessings, 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 and good morning. I hope everyone is doing well. You're here with Lashley from Primetime Homebuyer, your tax lien and tax deed expert, or your team lead if you're actually part of our course. All right. Good morning, beautiful. So today we're going to be doing a formal live. You know what I mean when I say formal live. We're going to be presenting a PowerPoint to you guys. So I'm going to give you a heads up. If you don't see the PowerPoint moving from slide to slide, please let me know. Sometimes the streaming equipment act up, but I'm going to ensure that the slides are moving. Now, today is going to be a continuation of a topic that we've been talking about for the last couple of weeks, which is real estate and taxes. No, I'm not a tax expert, but I have been doing my taxes for the last 4 years. I'm just giving you a background, just, people who are new to this platform. Not only do I invest in tax liens and tax deeds, but I also do it through my own business. And I do manage my own account as well as my taxes. So I learned a lot of the tricks of the trade because I love to research and I love to put information together. So that's what we have here for you. So as tax liens and tax deeds investors, foreclosure investors, real estate investors, no matter what, we have to pay taxes on our gain capitals. And there are some things that we can use to help mitigate our tax liabilities. So we were introducing business structures that are compatible with real estate business that you can consider a few weeks ago, as well as then we went into taxes, the foundations of some tax deductions that you should know as a real estate investor, I think about 2 weeks ago. Now, what we're going to do, this is going to be a little bit longer, guys, but get ready because I have a lot of great information. We're going to be using a lot of resources to present to you, making the most out of your real estate return. Using tax deferral because, once we make it, they want to take it. So we're going to get into tax deferral as well as instruments that can be used to help you defer some of the tax liabilities by placing those capital gains in tax-bearing accounts, non-tax-bearing accounts. So we're going to go into that. And then we're going to have one more part to this series, okay? So let's get with it. I said, let me start a little bit early because we got about 36 slides. Yes, we went in this week, and I really want you guys to know that this information right here is going to always stay on the public platform, which is Rumble, YouTube, and the Facebook group. And this is under Secure Your Energy. We want you to understand these aspects outside of investing just in tax lien and tax deeds, that process that I specialize in. We want you to understand the whole economic outlook of investing, okay, and being safe. Okay, and what to expect and how to maneuver. And it starts by actually setting up your structure, what type of business that you're setting up if you're going to invest in real estate via entity. Those are considerations which is directly related to tax liabilities. Okay, so we're going to try to do what Trump do. You know what I'm saying. You know how I am. We're going to try to do what Trump do and save as much on taxes as possible. Now, guys, if you cannot see this slide, please let me know, okay? If you cannot see me, let me see. See, I think, okay. I'm clicking through right now. I'm looking at it to see, are we clicking through? Okay, and it's not. Give me 1 second, guys. Okay. Is it? Okay. I think this is how I have to present it to you, because when I go into it the other way, it doesn't actually click from PowerPoint to PowerPoint. So I'm sorry that this is how I'm going to present it like this. You're going to actually see, but I don't know what's happening with StreamYard. We're going to do our best. Hope you guys are having a lovely day. Let me not start singing to y'all. Okay, let's get to it. We're going to go through this PowerPoint. Get your pens and paper ready. You know I have a lot of information to share. So making the most out of your real estate returns using tax deferrals. Making the most out of your real estate returns. So these are some of the concepts that we're going to get in today, which is tax deferrals versus tax investment. Advantages and disadvantages of tax deferred instruments. Those are instruments we're going to talk about. Key concepts to know to gain the most tax benefits. Ultimate real estate tax deductions to know. So we're going to go over a list of tax deductions for real estate investors. Minimizing tax burdens for real estate investors. So you can minimize the burden, not get rid of it. Some deferral eligibilities for gain income. And that is something that we're going to hit lastly. Okay. So defer or not to defer? That is the question. Tax deferment is an option that investors use to delay paying federal taxes, such as tax deferment accounts. So what we're trying to do is mitigate your taxes. We're not going to stop you from paying taxes, but we're going to show you how to play the game. In some tax deferment accounts, you are allowed to reinvest these pre-tax money to add on to your earnings. So when, for example, you receive capital gains from a sale and you don't reinvest it in a property, but you use a non-interest bearing account, such as what we're going to go into, 401k. And then most of the 401ks are connected to instruments that are related to stock investment portfolios. So that's what I'm talking about as far as that pre-tax money and added earnings for you. Some of these tax deferment instruments or account has stipulations that you must follow, such as early withdrawal fees. So we're going to get in those penalties and things that you want to know about when it goes to those tax deferral accounts, which is 401k, just to give you one example, in IRAs, but we're going to give you other examples as well. Tax deferred versus tax instrument. Tax deferral are considered methods used via taxation to spread the amount of taxes on the income received by the investment. So that's what tax deferral means. You're just kind of deferring it over a period of time. And we're going to give you some examples. Tax investments, most instruments are considered taxable unless categorized as deferred accounts or exempt from taxes. So 401ks are subjected to taxes, and that is based on the usage, okay, and when you withdraw. And either way, they're going to get some taxes out of that money. Tax deferment accounts. With tax deferment accounts, the IRS allows the individual to subtract an amount from their taxable income each year. So that amount that you cut, it comes in as income. Once you put it in this instrument, they allow you to subtract it for that year, lowering your tax bracket. The taxes due on this contribution will be due at the time of withdrawal. For example, we're going to give you more details. Many traditional IRA accounts are non-taxable versus Roth IRA, which are taxable when the money is paid in. So with the Roth IRA, you're going to be paying taxes on the front end. Okay. And with the IRA, you'll be paying taxes on the back end when you withdraw. Types of tax deferment instruments. So these are some of the instruments that you want to know about. It's not just 401k, guys. Employee sponsored retirement plans, which is 401k, which we all know about. IRA accounts, 403bs. We're going to get into what that is, and 457bs. They also defer accounts are instruments such as fixed deferred and variable annuity accounts. And we're going to go, what is a fixed deferred and a variable annuity? You could put it in an account and say, this amount is going to be fixed as far as the interest, and some of them are variable. So that's why you need to understand the importance of reading a contract and going into detail. And we went into reading contracts and some of the points that you want to highlight in general contracts. Okay. So I bonds or E bonds is what we're going to go into. Whole life insurance. This is something many people don't talk about, but a lot of rich and elites participate in whole life insurance. So we're going to go into the benefits of that and the disadvantages. Excuse me, guys. Tax deferred savings accounts. These tax deferment savings accounts allow the taxpayer to postpone paying income taxes on investments until its withdrawal. I keep stressing this because I don't want you to think that you're not going to pay taxes, but we're going to show you how to kind of maneuver around with some more details. This withdrawal will usually take place at or around the time of retirement. So a lot of these tax deferred accounts, they pay out at time of retirement, which is the 401k, the IRAs, and the Roths. Okay. An example of these type of deferment accounts, as we just said. Fixed deferred and variable annuities. Now, this is basically when you're going to get a fixed rate versus a variable rate. And you know what I say, always go for the fixed rate. Hopefully you're in a good term at that time. Hopefully it's term bound, which is 5 years, 6 years, something you can look at again and negotiate, depend on the economy. And that's just based on when you're dealing with interest, okay, and dealing with these type of instruments. Okay, so fixed deferred and variable annuities come in packages under insurance products, okay? And these insurance products, they are investment avenues. So for instance, where they had a whole bunch of home loans, even though that wasn't the best thing at that time in 2008, in these packets, I forgot the name of the instruments, but they were packets of, like, the mortgage companies will basically sell portions, or how can I say, portions of the loan to other investors. So an investor can buy a packet of 50 loans and receive 10% or 5% or 0.2, whatever their fixed rate or the rate that they decide to at the time for a certain amount of time. So this is how they were selling, like, bonds and those type of instruments. So I'm just giving you an example when we're talking about fixed deferral and variable annuity packages. Okay. So they could be coming through insurance instruments or bonds, government bonds that we're going to talk about. Now, broker companies can guide you in the use of these insurance products with flexible or variable annuities. So you're going to have a brokerage company that you really trust, or they have other avenues like Robinhood and things like that where you can invest yourself as well. This will help guarantee that the death benefit and elimination other uncertainties and limitations at the time of death. So basically, having these instruments, I do apologize, will guarantee that the benefits will be paid out, eliminating other uncertainties and limitations at the time of death. I do apologize. I got a little tongue tied. So this is what these packages offer. Is no ifs, ands, or buts about it. If you have a person that is a beneficiary, they're going to get it straight and direct. Okay. It's not got to go to mitigation through court or anything like that. And have to pay to get it distributed. That's what happens upon death when you have money that's out and you don't have them in instruments, or you don't have a bank account with somebody already having the rights to it and know what to do. These tax deferral annuities are set up to receive regular payments after a time. So at a point, like for instance, if you buy a bond, they'll say it's going to pay out after 15 years, every month, this amount. based on you holding it in a bond. Same thing that happens with these IRAs. Sometimes they force you to get payout at a certain time, and we're going to talk about that. Investors can pay into the annuity account over the years and be paid out in installments after retirement. So this is supplement insurance supplement income that you can start to create now. That you want to keep in mind. We are 40 years old above. I know we got some 28-year-olds here that follow me. We're planning for the future. Okay, if you at 40, it's not too late. These are some of the things you need to think about now. All right. Investors can pay into annuity accounts over the years and be paid out in installments, as we talked about. These contributions are non-taxed and considered to be tax deferred. The contributions, but when it pay out, you pay taxes on it. Taxes are due on the earnings are at the time of payout. Fixed, deferred versus variable annuities. Just to continue, these deferment annuities have or can be fixed. You want to kind of keep that in mind, especially based on the economy. You don't want the things to fluctuate, and literally people lost a lot in 2028 if they didn't have fixed annuity rates. They dropped. You see what I'm saying? There was no matching going on, and a lot of people lost money. So that's when we're thinking about the concept of having fixed annuities, especially in an economy like this, okay? Offering the investor a rate or return that is agreed upon. Some of these rates can be variable, allowing the individual to choose from a variety of investment tools that can increase or decrease the payment in the future. Heads up. So you'll be able to invest in a variety of investment packets. But with that goes to say, you hope you want to keep it at a term so you can still have some flexibility. You don't want it forever, ever. You choose this packet is, and that's it through the life of the whole instrument. Does that make sense? Because this can cause fluctuation in the future payouts. Now let's get into 401k and our IRA accounts. I know y'all know a little bit about that. Y'all can create your own as business owners as well. But or if you have them through your conventional job, this will just give you a little bit more background. 401k and IRAs are the most common tax deferred saving accounts. Many corporations offer their employees 401ks for tax deferment retirement accounts. In many cases, some employees match a portion of the employee's contribution. Okay, let's make sure. Okay, just make sure I can hear me. Keeping in mind that the money that is introduced to the account is gross income. Okay, it's based on gross and is not taxed. The investor can receive an immediate tax break on the income by placing the money into the account. And this is what you're doing at your job when you're placing it in 401k or IRA accounts. Now, what is a 403b plan? 403b plan, these type of tax deferment retirement plans are used more so for nonprofit organizations, public schools, and other religious institutions. So if you have any of the above, this is the plan. This is basically similar to the 401k. These retirement plans act in the same capacity of 401k plan, allowing employees to contribute to the portfolio of the employee, and those contributions being tax deferred. In the same capacity of 401k, early withdrawal from these types of accounts will cause the investor to gain penalties. Now, there is some situations where you don't receive penalties, and we're going to go into that. There is some flexibilities with these type of plans, but you want to make sure that they're actually in the plan. You don't want to just assume it. That's why we're going to read it, ask the broker questions, and ask them could they refer you to where it's at in the contract. Don't play any games these days because they are not regulated. All right. So as well as they're regulated to do what they're supposed to do, but you know how it is. Let me just stay focused. Okay, so as well as when the deferred tax investment monies are contributed to post-retirement, they are subjected to regular income tax. Okay, so if the contributions are still going in post-retirement, they like, okay, you're going to get taxed. You're not going to get double tax, but you're going to get taxed. So some people still contribute to these plans after retirement because they have so many of them. Okay, and they want them to pay out a certain time, or they want to be able to withdraw if something was to happen on a particular one. Let's say if they felt like they were going to get sick, they have a plan or money that they set aside for that. The benefit of or have this type of plan set up. The 403 plan is that it works similar to a Roth. This is what the 401(b) plan is similar to a Roth, offering its investor tax contribution free of penalties when withdrawing is done during retirement. Okay. But with the Roth, you're still going to be taxed on the front hand side. So the 474, let me make sure I got the right number. 457B. Give me 1 second. That number looked different. Okay, sorry. I don't know why I thought it was just a different four. I thought it was something different. Okay. 457B plans. These type of tax deferment retirement plans are used by employees of local governments and some other nonprofit organization. Again, they're like the 401k and the 403B plan, in which contributions can be given to the investor via an investment account. And as I say, you can use these investment accounts to invest in agriculture, health, whatever package that they put together that they offer you. And they're very diversified at this point because they're trying to keep in competition with their competitors like Robinhood, the do-it-yourself, So this helps you to reduce your tax liability for that particular year because you put it right into an investment. Benefits of tax deferral plans. And we're going to get into some of the non-benefits. Okay. So the goal is to reduce the amount of tax that's due each year. That's all we're trying to do. That money that you're getting from real estate, the capital gains, if you're not about to put it into another property, as what we talked about with the 1031 exchange, and we're going to re-mention that here, which is basically like property when you're buying, investing, and that's how you could defer that money and just keep building up on equity until you're ready to cash out. Now, if you're not doing that, you need to find something to do with that money because it's going to be taxed. That income is going to be taxed. Okay. And it's going to put you in a different tax bracket, which causes you to pay a little bit more taxes. So the goal is to stay in the lowest tax bracket that you can and make the most money. Does that make sense? So now so the goal is to reduce the amount of taxes that's due each year by placing your money in these type of accounts. Can contribute to lowering the federal tax owed on an individual yearly. Some of these tax deferral plans, you are offered a choice to invest in mutual funds. These allow your retirement monies to grow steadily. Depends on what's going on with the economy. Remember, fixed rate versus variable rate. Okay. After retirement, this money can be withdrawn without penalty. Okay. Early withdrawal fees. So this is what you need to consider when you're using these packages. You don't want to just go in and say, these instruments. Oh, I'm just going to get a 401k. I'm going to do this and that. And if something happened, you have your money so tied up. And then when you withdraw it, you're getting more penalty than what you would have did if it just sat in a conventional savings account. Okay. So early withdrawal fees, when using these traditional tax deferment account, it is important to understand that you can face early withdrawal fees. These early withdrawal fees can be exempt from taxes if they are used. So this is where you can use these, overcome these withdrawal fees. If the account holder become disabled, using the funds to buy or rebuild a new home, i.e. 1031 exchange, money used for emergencies such as medical expenses that are not reimbursed. And you want to consider, like with the COVID, I don't know if they gave some flexibility for people who were pulling out their 401k, but that seemed like that was a natural disaster. I wonder if they did that. Okay, so monies can be used for assets for college fees and other higher education. So as we say, certain individuals put these to the side, particularly because they know they have their young kids going to college and they want to have this available to pull out for them. Now, going into I bonds or E bonds, Series I and Series EE savings bonds are used to lower the risk in savings products. Okay. This is the same thing. This is an instrument. You have to talk to a broker about this. These bonds can be invested in and have both a fixed or variable rate. Remember, and can have a term of a life. Let's say I buy bonds from China. I'm just talking on a government level because that's where a lot of these bonds come from. And it'll be a 15-year, 25-year term. And the interest rate could be variable, where in agreement it could go up every 5 years, or it could variable based on the economy or the business structure or whatever we're invested in. These are the things that you want to keep in mind when you're looking at these contracts dealing with bonds. These are all contracts. I consider everything a contract. I'm like, let me see that contract. Okay. So in some cases, there are interest involved in these bonds, which can be deferred until you cash it in. So even if you're getting the interest yearly and you're seeing it growing, doesn't mean that you're going to be paying taxes on it right away. So let's just keep that in mind. And sometimes it's a benefit because if you don't cash the bond and you keep it for the life of the whole, like it's a long life, sometimes they defer you on taxes because the life of it is so long, and you contributed so much. So in some cases, if the bonds are used for education, the tax can be deferred. I-bonds and E-bonds. The E-bonds are Series I-bonds are U.S. savings bonds that are issued by the government. So the E-bonds and these I-bonds are the ones that's issued by U.S. government. And that's how we got out of the 2008 housing crisis, because they sold these particular bonds to allegedly China. Okay, yes. Look it up. Okay, that's how they got reinvested in, because America is a business. When I whisper, that's something y'all need to just go look it up. Anyway, moving forward, the Series E bond pays interest throughout the life of the bond. Okay, so there's interest throughout the life of the bond, which can extend up to 20 years. Okay, these bonds that you're going to use these for generational wealth. Okay, I bonds work a little different, paying interest up to 30 years. These interests paid to the bond holder. This is a I do apologize. This is a non-tax until the bond reaches its expiration date and is redeemed by its investor. So you want to know the details of these type of bonds that you invest in. This money can become tax-free if the money is used for educational expenses. Again, now just to my Canada listeners, because I know we have people in Canada trying to get out of there. Canada is on fire too. It's a lot going on with the economy, their birth rates. I think Canada stopped accepting migrants because the job market is a lot going on. So I'm not promoting migration to America because we full, but shout out to Canada. Got some information for you. So Canada RRSP, also known as Registered Retirement Saving Plans, which is pretty much the same thing, similar to IRA account. It offers to their Canada taxpayers where contribution is guarded from taxes until withdrawal. So shout out to Canada. Now, let's go a little bit into whole life insurance, because this is something that many people do not participate in, but the rich and elite does, okay? The rich and elite does participate in this, okay? Because this is like having your own bank. When they say have your own bank, this is what it means, okay? Whole life insurance is a permanent type of insurance, okay? This insurance lasts your whole lifetime. This policy are substantiated by regular payments by you, highlighted that a portion of these payment premium goes towards a cash value component. So it's not just the life insurance, but some of the portion of payment goes to a cash value. That's why per se it costs more to maintain it. These insurance can be up to $250, $500 a month, depending on what your actual payout is. What is your insurance coverage? This cash value components can be drawn upon with penalty. So a portion of, let's say that $250 will be going to the insurance payment. Let's say that's $100 a month, and then $150 will be going into the draw out component, or 100, let's say, and then $50 in management fees or whatever, because you have to pay that. I'm just kind of throwing a big number. That's a lot for management fees, but I'm just giving you an abstract number to understand how whole life insurance work and how it could be really beneficial for you too. If you get yourself to that point where you have, some residual income coming in from real estate investments, or, tax lien, real estate, whatever, this is something that you could keep in mind. So it'll help you defer your money. So the good thing is that the penalty will be paid back to you, the owner of the whole life insurance. There is a portion of the penalty that will go back to the management company, but they like to say if there's a 1% penalty, 2% penalty off of withdrawal, when you're paying that back in, just like you would want to do with your 401k, this is going to be your bank. This is going to be your bank where you're paying it back into your bank. This is a lifetime family bank. Just, keeping that money up because they matching it. You get times where you could withdraw because these things pay out. Okay, a whole life payout in the term as well. So if you get to like 50 years old, whole life will pay you this much because you contribute all of this time, and then you still have the insurance base and you still have monies that you contribute sitting and waiting. That's how whole life insurance work as a benefit. So the good thing is that these penalties are paid to the portion of you and the holding company. The cash value builds up over the lifetime and is not taxed, making it tax deferred. Everything that happens within the account is tax deferred. Many investors use whole life insurance as emergency funds. That holders can take cash value easily, grow cash value quickly, and grow without tax involved and interest can occur. So you have four aspects to this. Cash value can grow easily because you're contributing to your own bank, and it's a matching portion, depends on what you actually set up, what they offer. That's growing cash value quickly. That's two. Growing without taxes involved, and interest is occurring based on some of the instruments that they have that you can add to your portfolio to invest some of that money that you're putting in. So you got three aspects to that. You got money holding, you can invest through a whole life insurance, and you get insurance payout if something was to happen. Does that make sense? All right. So advantage and disadvantage of tax deferment investments. So we definitely going to get to the good, the bad, the ugly. So the advantages is some tax savings. Compound interest can occur. There is some flexibility. The disadvantage, withdrawal limitations, as we mentioned, tax penalties, and RMD, also known as retirement minimum distribution. If they have a retirement minimum distribution, that just means at a particular age, they're going to start paying you out. And in some of those terms, when they pay you out and you still contributing, you have to pay taxes on the contribution because it kind of changed a little bit. Okay, so let's keep it moving. Advantage of tax deferred instruments. We're going to get into some details about what we just mentioned. Tax savings. These accounts can help you defer taxes on investments. I'm reiterating. Yes, I'm teacher's going to do that, in which profit is gained. These tax savings accounts can help reduce tax liability yearly. By not having these monies available to you, this can put the taxpayer in a different tax bracket, allowing them to save substantially. Okay. Compound interest can occur. When dealing with these accounts, there are advantages to build up compound interest while deferring taxes. Usually in these accounts, they allow you to reinvest the money into other instruments to build interest over time. And those instruments included bonds, government bonds, the mortgage package, stocks, different things, stock packages, things like that. Okay. So advantages, and when you're looking for a brokerage company, that's what you want to compare and contrast them on based on the services they can provide for you, the fees that they offer you, and the diversity of their packages. Okay. So advantages of deferred investments. Let's get into it. The great flexibility. Tax deferment investments allow you to have more wiggle room with your money. By the investor having a variety of investment options. So you're not just, let's just put it back in real estate. Just if that's what you want to do, that's fine. But this is more passive. Once you set it up, you set it up. The hardest part is setting it up, finding a good brokerage company, and then going back to reevaluate your portfolio. And you'll get used to that if it fluctuates that much. Okay. They are allowed to move their money through their portfolio. You see, this can help them manage their investment and implement strategies to help them defer taxes. So sometimes you can pull out the portfolio, get a little penalty, but maybe it's worth it because maybe you have another investment property that you want to put it in. Like, well, this penalty it is what it is. I'm going to make this amount if I could take this for $40,000 and put it in this home and increase the value to $300,000. Okay, things like that. So you gotta weigh your options. Sometimes you got to pay the fees, but sometimes it's worth it sometimes. So disadvantage of tax deferment, just getting into details of some of the concepts we talked about, which is withdrawal limitations. When dealing with these accounts, there are withdrawal limitations. If you do not adhere to, as an investor, you will receive penalties. in many cases, because you'll be penalties from the company, from the actual, withdrawal, and then you're going to get penalties on the backhand side where you're paying taxes, and sometimes they give you early withdrawal penalties when they deal with taxes. Does that make sense? Now, in many cases, there are age requirements for you to withdraw without penalty. So you want to know those age requirements. I'm 40, so I could hold out for 19 years, before I can start withdrawing. So let's keep that in mind. Can you hold out for the term that when you need the money? These monies can be accessed in times of unforeseen circumstances or financial needs. So do remember that we highlighted those type of situations. Disadvantages of tax deferred instruments. The tax penalty is the disadvantage. If you withdraw, and they're gonna get some of them taxes. Hold on. Why I skip like that? Okay. Now, with many investment instruments, the government will receive their taxes either on the front end or the back end. I just got to be honest. Our goal is to get it as low as possible, the lowest rate, and defer it as much as possible. Okay. Early withdrawals from these tax deferment accounts can be subjected to large penalties and taxes, and that's not just from the actual company, it's from the government. Understanding the repercussions of withdrawal from these accounts is something that you should consider on the front end side, because you can lose a lot of money if it's high fees, and especially if it's based on a percentage of your money, not just a fee amount. That's a problem. Okay. So the requirement distribution can be a disadvantage as well. Okay. This can be another drawback from investors because they are required to withdraw a certain amount by a particular age. There are some individuals who have more than one 401k and do not use until it's closer to the end of life. But what I would think is just take that money and invest it in a newer 401k or some property or some gold, because we're going to talk about gold too, okay, in the next up and coming weeks. Okay, keeping an eye on the gold market as well. Some companies make you use or start to withdraw minimum amounts from the account starting at the age of 70. So that's not too bad. Hopefully people living to the age of 70, these days. All right. This can be a disadvantage for people who wish to continue to grow their investment in tax defer. So some considerations you want to make as an investor, a business owner, anyone who makes money and want to plan for your retirement and defer some money. Your personal finances goals. What are your goals? How much do you make? How much you can save? Retirement age. When are you planning on retirement? How much can you actually save in that time? What instrument will be better for you to use that can match how much you want to have? Because you want to use something that can match your contributions or at least get you some interest. Risk tolerance, looking at the market, what instruments are more risky? Contribution limitations, sometimes they have limitations where you can't go past a certain amount, and that caps how much you can get back. Fees and expenses, sometimes they have fees, broker fees, expensive paperwork. You need to look at those fees. Some of those things are ridiculous, and because we don't have any our Consumer Protection Bureau has been defunded through the Dodd-Frank Act that was defunded under Trump, which allow a lot of companies to have more flexibility because the little guy doesn't have the government to fight for them no more. They're doing a little bit of predatory things. So you have to really pay attention to what you're signing up for, because we have talked about a lot of housing scams where the people were signing their homes away. Okay. And then there's nothing that they can do because there's no law in place right now that makes it a crime. Does that make sense? So we're making our way down. We have about 10 or 11 more slides. I want to say thank you for being with us today. This information I find very, very important because this information is not really shared to us on a public level, just on platforms, just so you can know, so you can maneuver. This is usually specialty information that I share here, which is tax liens and tax deeds. But because I love to learn and share information, and I feel like if people understand the economy and understand how to maneuver using these instruments and how to build equity and build assets, we'll be able to have more leverage of what goes on around, not only in our economy, but also what goes on with the law, how things are regulated. What you have noticed that the housing market, as I mentioned, is inflated. It's not because a little guy like me and you are buying properties and saying, oh, we're going to rent it for $1 million. It is companies. They're companies that's taking over. And that in itself, just to get a little sidetracked, is making it hard for individuals who are starting out. Even if you didn't have bad credit, you didn't do anything, you don't have no credit. These companies are making requirements so hard for you to get an apartment and things like that. I was mentioning to a friend, when I started out I had my first apartment at 17, going on 18. I was able to make enough money by doing here, working at McDonald's, and they gave me opportunity. I have no credit. I was coming straight out of my mother's house, and that was a person that allowed me. He was my landlord for like 3 years, which was good. People don't have the opportunity now because these companies are taking over and making these stark requirements. And I'm not saying these requirements are not needed, because we got a lot of scam artists. But what I will say is that you have to balance this out. And the only way we're going to balance it out, people like me and you, understand the foundations of our actual situation, which is law, economy, rules, regulations that allegedly specialists only know, that we go to. And sometimes they take advantage of us. Okay. So, not to get sidebarred, let's get back into key concepts to know. Gaining the most tax benefits. So these are just a few helpful hints that I'm going to give you. Implementation of gaining or loss from sales of real estate. So understanding what it means to lose or gain. Keep in mind that when dealing with real estate, there's a possibility for investors to have capital gain taxes, face depreciation. That's something I really didn't talk about too much, but we're going to hit depreciation in this concept, this PowerPoint too. Depreciation rules, gain potential tax deductions. Also, holders must follow specific rules related to the type of property they own. Example, rental property versus vacation. We talked about that in the last live, where if you are renting the property out, you follow these type of tax deduction laws and rules. And if it's a vacation, you fall under this, and there's other restrictions under vacation home. Like you can get tax deduction for furnishing, but not over excessively furnishing. And that's stated in the IRS code. I was like, wow, people was like, I spent $10,000 on a 5x5. IRS is like, nope. So key concepts to know: gain the most tax benefits. Opportunity funds and tax deferments. That's something we went back to. We do have a video up there about opportunity funds and how to look for some of those. I think it was on the NACO video. I love NACO. It has so many resources. Basically, you could go to NACO and look at all of the states that they have available on the website in their government official directories and find these opportunity fund programs, zones, actually, programs that they offer to give incentive to investors like me and you, or the big companies. You see, we got to get in there. So that's why I'm sharing these resources with you. So opportunity funds and tax deferments is a concept that you want to keep in mind too. When you're playing the tax game, opportunity funds is a great investment for new investors who want to help to rebuild a community. There are in need for restoration. Investment in opportunity zone promotes tax deferments for their investors. So you get the tax deferments, and also allowing them to grow their organization to have potentials for higher returns related to not only the diverse portfolio, because they incentivize you to build a group home, do something like that. Maybe go out your pocket, go out of your not your pocket, but go out of your conventional way of investing and maybe build something for the community. But also they offer an infusion of capital related to the opportunity fund. So if you come in with this, they're going to be like, okay, you built this and you get up and running. We're going to give you a stipend every year to have the program, but you just need to follow these particular guidelines. So that's how you're infusing not only money and getting tax deferments. So I love opportunity zones, and I will hope one day soon I'll be able to invest in some opportunity zones as I'm playing the tax and lien, tax lead game. Okay. So let's just highlight the 1031 exchange and its implication. If you don't remember that, we're just going to touch bases. Many investors use this method to defer taxes. 1031 exchange allow the investors to swap properties after selling a property, reinvesting in the property that is like value or similar. So this is according to the IRS website. According to the IRS, the identification of a property is like kind property to qualify for the tax deferment. So you want to go into the IRS website to find out details about like kind. I think like kind does have to do with the value as well. So don't think that it's just the way it look in the size. It could be the size though, because the value could be more in another place. So you gotta look that up. Okay, so key concepts to know. Come on, looking for it. State tax breaks. Yes, states offer tax breaks and incentives as well, not just particular local municipalities. It is a good strategy for investors to look for a variety of ways to save money. This can be done on a state tax level. You will find that many states implement tax deductions, credit, exemptions, and incentives for business to participate in local commerce in the state. For instance, Baltimore, that's what I wanted to mention. Baltimore was trying to sell properties for $1. That was a state incentive program. Okay. When we talk about trending topics, I think we probably do one next week because I got a busy week. So we're going to make it spicy. We're going to get into what Baltimore we're trying to do for incentives. Okay. So finding out about these special programs can help an investor that is interested in property improvement, rental properties, flipping real estate, or being generally a general developer expanding their portfolio. Now, we're going to get into just a little bit of depreciation and recapturing, and I think our last part to this, I'm not like there's another part. It's so much information is going to go a little bit deeper into depreciation and recapturing so you can understand it a little bit more, because we do have another part, and it's not going to be next week. It's going to be probably the week after that. Okay, I'm going to tell you what's coming up in the next 2-3 weeks. Okay, so the key concepts for depreciation and recapturing, this is the method that the IRS use to recapture taxes from gain income or a depreciated asset. So just because you're taxed on your home this time, this amount, when the depreciation of it is considered and a certain amount is actually taxed. Okay, so you want to definitely go into the IRS website and understand depreciation, but we want to have our next live, we're going to get into it in detail. So just in a nutshell, the IRS separates an asset that is depreciated from other capital gains, such as income. So the house will be considered separate, and they're going to talk about how long you had it and the depreciation over the lifetime. For instance, if you buy a computer, they have depreciation over that as well for your business. You can claim a percentage of it this year or next year, and then if you want to claim it next year, they consider depreciation if it even have value. Okay, so that's on actual equipment, and home is like equipment. So gain income from a depreciated asset can be taxed at a different tax rate. So because it is depreciated, and you owned it over a certain amount of time, the tax liability do decrease. Key concepts to know. Okay, depreciation recapturing. When an investor is selling their property, depreciation is considered. This means that the percentage or a portion of the gain income attribute is taxed at 25%, not the full amount. So if you have a gain income of 100,000 and you have a depreciation consideration of 75%, I'm just throwing something out there. Don't quote me. They may just 75% of that $100,000 will be taxed. Does that make sense? So that's just an example. Basically, only the portion of the gain income is taxed, not the total value of the assets. Okay, based on a depreciation value percentage. And I don't know that index. That's the IRS thing. Okay. Now, this is consideration because the next part we're going to be talking about more detail about businesses, entities, because you see how this is focusing on the deductions and understanding gain taxes and just the general structure. Our next series is going to talk about business entities, partnership, and being considered a real estate investor. So, what that goes to say, that connects to this, because just because you have a business that says I'm a real estate investor, the IRS is like, hey, if you're not making no money, you don't do these particular things, you are not an investor. But in this particular, you're probably, this is a hobby. They consider it a hobby. So we're gonna distinguish that in the next part. Does that make sense? So in this particular slide, if you have an S corps, because we talk about having more flexibility with a partnership, limited liability company, but there are very more restrictions with S corps and C corps. So remember this: if you have a S corps, limitation in tax disadvantages do apply. As a business owner, a real estate investor, it is important to know how your organization structure affects your taxation. S corps has limitations on real estate taxation. So it's limitation if you're participating as an S corp. It is important for investors to know that limitations while investing as an S corp and operating as a real estate business. So we're going to go into that, but that's something I want you to keep in mind, that there are limitations. So that's why you need to choose the correct entity to have when you're participating in real estate. So S corp tax disadvantages in contrast to LLCs or individual owned businesses. The S corp has many limitations related to financial losses, debts, and distribution related to the property. Some things may not be considered a write-off because you're an S corp. Okay. Okay, so let's just get into ultimate real estate tax deductions. To know, this is just a few list of things that you should know. These will be found on general websites, but let's just get to it. These are certain things that you can deduct off as a real estate investor: commission and fees, legal professional services, contracted labor and wages can be deducted, advertising and marketing expenses, and listings as well if you rent out, gifts and donations. And that's if you're a company. If you're a company, you could do gift and donations. Okay, not just a regular real estate investor. Home office deductions, business meal investment. Expenses, professional meeting, conference, and publications, educational trainings, office rental space rentals, health insurance. Maximizing your business deduction for real estate investors continue. So available deductions, rental repairs can be considered, and this is for people who have rental properties. Depreciation strategies need to be kept in mind that we talked about, because that can help you save money. Remember, travel expenses can be deducted if you have property in other states. You need to keep great detail receipts. Property management activities, rental insurance premiums, property management expenses. I said advertisement and marketing. Sorry. Property taxes is considered, it can be considered write-offs as well. Legal and professional fees, furniture for rental and vacation properties within limitation, guys. I had to highlight that because even the IRS was like, baby, don't think that you're going to be writing off all of this expensive stuff. You better keep it moderate. Okay. Interest expense deductions. So interest expense deductions. So if you have interest on something that you're paying for, some of those things may be able to be deductible. Depend. See a tax experts for details. Okay. So keep in mind that the rental property is subjected to depreciation as well. This can offer some tax benefits to the investor, allowing investors to buy and hold and deduct the cost of building over the use of the lifetime of the property. So you can take some of that extra money and reinvest and increase the value. Now, minimizing the burden for real estate investors continue. We're getting down to our last three slides, guys. I told you this was going to be an intense live, had a lot of information. Please put this on the playback. Please hit the like button. Get us in the algorithm on YouTube. Rumble, thank you. I know you got us in the algorithm. Please hit the like button. Please subscribe. The more that I know you like the information, the more I will share. Okay. So other ways to minimize the burden: offsetting taxable income with real estate losses. Okay. So it can be done when keeping the concept in mind of depreciation and operational expenses for real estate property. because the cost of living has went up, the cost of buying materials has went up. So people have been subjected to losses, having to fix up properties, do things to get them up to code. And it's like, just for example, just the cost of wood, it's like double, triple over the years. It's ridiculous. It's hard to put up a fence. Just know that. So the laws can be used to offset other taxable income in a given tax year, such as wages or businesses. So, for instance, if you still work and you made $70,000 a year, but in your business you end up losing money, that will offset your income tax bracket. That'll help you. Does that make sense? Yeah, yeah. So carryover strategies, these strategies can be implemented as well. If you have losses that exceed your income related to real estate property, this process allows you to suspend passive losses in the future when you have significant amounts. So if you have like a big loss this year and you literally negative 13 $30,000 loss, you can postpone that loss and put it into the next year. And if you have a significant amount of gain, you can apply that loss to that year. I want you guys to verify that with the tax expert and the IRS. Okay, but this is via my research off the IRS website and specialty tax websites that I have been all over and just looking for information. Okay, all of this stuff has been reworded by me, reading and transcribing it into my own words. So. Carryover strategies. These strategies can be implemented if you lost, as we talked about. So these losses can be carried over from previous years. Now, one of the last slides. To minimize your tax burdens for real estate investors, to help lower your liability, it is recommended that you create an entity. This is just for informational, educational purposes only. Create an entity or have a partnership that can utilize certain tax credits in the sense of availability, such as activities involving state funding, promotion, and opportunity zones. So you get subjected to that when you're a business, not just a regular real estate person. You come like, I own 50 houses, but they're going to want to see an entity. So that's the importance of having this set up and having your name and your business set up for years. Even if you wasn't making money, they're going to see the longevity of it. So start this year and take your time. There are certain criteria that a profession must meet to be considered qualified real estate professionals. Okay, and that's in the eyes of the government when you're looking to get opportunity zone investments, but it's also in the eyes of the IRS. So our part two is our part three, which is the last part, guys. Yes, yes, yes. We're gonna get into considerations. What do the IRS consider? How do they consider you an actual? Hold on one second, guys. Yee. Oh, let me get myself on the screen. What are the actual qualifications you need to meet to be considered a real estate investor and a business owner at the same time? So that's what we're going to go over, and then we're going to hit some focus concepts for you guys to remember to add on to this information that we've been sharing. So there are more tax hints and tips that I'm going to be giving you, and some reminders in that last part of this series. So after that, we have next week, we're going to go into a trending topics. Okay, we're going to keep it a little spicy, have some fun next week because I got a busy week. The week after that, we're going to possibly go into the business entity that we just talked about, or we're going to finish off understanding your home loan for home and home investors, people who own homes, period. People who own homes via loans. That's what I got tongue tied because I don't like loans. So I'm like, loan. Okay. The people who own loans for their home, there's a thing called escrow accounts. And I want you guys to understand your escrow accounts, and I want you guys to understand your rights. Sometimes they take too much money away from you guys and the guys that they're holding it for the escrow account. It can work to your advantage or it can work to your disadvantage. But I want to keep in mind that a lot of us are not having that significant amount of income right now. So they're trying to keep as much in pocket as possible. So that's why I'm going to go over that. So that's what we're going to be doing for the next 3 weeks. I hope this was a great live. I hope you guys learned a lot. This will be available. If you have any questions, please put them in the chat. I am available to ask questions, as well as I want to go on the screen and give y'all an update of when we're going to be doing our next live. Shout out to Primetime Home Buyers Tax Lien Group. Last month was nice. We had about 5 individuals that showed up for the free seminar that we give monthly. Our Q&A, you can ask as many questions as possible. I just present a small presentation. If we have 1 or 2 people, I let you guys kind of tell me where you're at, and I focus in on that. So with these free sessions, what happened? This is the second time it did that to me. Bear with me. This is the second time it had crashed like that for some apparent reason. Now, with these, you're going to go to services. Something happened with this. Let's move a little slower. Bear with me. I guess a lot of people are on today. Let's see. Well, what is going on with my website? It's not the website. It got to be my computer. Bear with me. I'm trying to pull up the calendar for you guys. All right, we're having some issues. What I'm going to end up doing is doing a short live. What is today? Possibly on Friday because I'm off. So I can give you guys a heads up on when we're going to have our free Q&A. We have a free monthly Q&A. Wherever level you are at, whatever questions you have, I want you to join the Facebook group. Ask your questions. I am willing to answer, or I'm willing to direct you in the direction where you can receive your answer. So we'll be putting that up on Friday. I want to say thank you so much for being here with Lashley, being part of the buyback team. Share, like, and share. This information is for the general public, and it will be up for everyone. If you have a membership on our website, we do have everything nice and organized for you guys, so you don't have to go to the public platform. So for your $19.99, everything is in order for you. Every secure your energy, whatever we offer you as far as availability of the hints and tips, whatever PDFs we have, everything's in order. So that's the benefit of joining the website for $19.99 a year. It's only a yearly. But if you really need help with the program and you need to get started, meaning you need to know the mechanics, is this safe, not safe? Where do I go? What the entities I deal with? If you're pretty new to this, the full course is for you. You get access to the introductory course and the full course and all the PDFs. I did talk to one person. They were asking what was the difference between the foreclosure seminar and what is offered inside of the course. Let's keep this in mind. The course is a 14-hour course. So what that goes to say, I had a lot of information to divulge from top to bottom in that 14-hour course. So we gave you as much information about the foreclosure process as possible, meaning the general mechanics of it, how the different ways that you look at foreclosure, meaning either from the perspectives of the government, foreclosure on the person that owns the property, if it's turning into a deed, we explain that. Or if you're the person that has to move forward with foreclosure procedures after a deed, we explain that in the course. And we also explain if you don't have to do a foreclosure and you just have to get the title cleared and those things. But what we do in the seminar, it's a little bit more detailed. It's literally about 8 videos of 45 minutes. So you have to say in that itself is about 7 to 8 hours of information focused on foreclosure. We're talking about timelines, concepts, example of one state foreclosure, where to get the laws from. So it's much more detailed in the seminar because I couldn't put a 7-hour portion into that course because it would expand the course and expand the value of the course. So that's the difference. But the general foreclosure portion of the course is about an hour. Because that's a good bulk of it. So it's about an hour of about 2 hours or so of the actual full course, because you need to know what to expect to solidify the deal. You need to be looking at the end game. So I wanted to just revisit that information. If anybody was questioning what was the difference between the seminars and what's in the course, because it will reflect the same name. Like it says title search for seminar. And there's a title search section inside the course. That seminar is about 7 hours. The title section inside of the course is about 2 hours, 3 hours. Does that make sense? So it's still a lot of information. It's still going to blow your mind. You know how Lashley like to talk. But if you have any questions, please feel free. The website is here. Inbox me and please join the family on Facebook. Okay, we're going to be more active on that profile. I appreciate you. I love you guys. Stay blessed, not stressed, and go get the money. Go get the money.
The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, realist investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all? Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.